We talked there about the link between volatility in treasuries and the stock market. I know your focus is on the fixed income side, but in terms of that volatility, do you expect that to be continued? Because it seems to stand out. Does it stand out to you as quite unusual?
Absolutely, and we believe that that's the main cause of higher US Treasury yields. And as we are heading towards another quarter of big supply coming from the US Treasury in the long part of the yield curve, yields will adjust higher. And I'm sure that you have talked a lot about the TLT ETF, which tracks US Treasuries with more than 20-year maturities. We are still bearish that part of the yield curve, and the reasons are two. First of all, we don't believe that anything has really changed since the last Federal Reserve meeting. And yes, there is 4 rate cuts priced for 2024 instead of 3. But when we look at the 3 months SOFR curve, we see rates to drop at 3.8%. If we consider that historically 10-year yields have been trading with a pickup over this rate of 100 basis points to 150 basis points, that pinpoints 10-year US Treasuries at around 5 to 5.5%. And secondly, as you just said, well, the supply and demand remains unbalanced. Yesterday, we had the U.S. Treasury selling $40 billion worth of 10-year U.S. Treasuries, and demand that was not great, despite being the last refinancing of the year. The 10-year that was issued yesterday is more liquid than the previous one, because it's the one on the run, so it should have received big demand, but in reality it doesn't, because the traditional buyers are not there. The Federal Reserve is a net seller, and U.S. banks have less balance sheet.
Althea, that was a very comprehensive answer on the long end of the curve. I'd very much appreciate it. And you've made very clear that you think long end yields can go higher. Can I clarify that this is really a view on long end yields? You're not particularly worried necessarily about more Fed hikes. And does that mean that this is ultimately very much a curve steepening view? And if so, how much can the curve steepen over the next few months?
We are still believing that the yield curve will steepen, and you are right, Mark. We believe that this is the peak in interest rate hikes, but the Federal Reserve is going to stay higher for longer. And that means that the front part of the yield curve is going nowhere for a while. It's going to be pinned down around 5%. The long part of the yield curve will be free to move. And that move that we have seen in the past month, that bear steepening, is likely to resume. What we have seen in the past 2 weeks is a bull flattener. But really, the direction is for a steepening of the yield curve. That means that investors will eventually buy the short end to sell the long end, and at the end that will still weigh on long part of the yield curve. But Mark, we favor a barbell. We think that the barbell strategy is great now for investors, which is buying US Treasuries up to 3 years, where it's almost impossible to lose money unless yields move up by 200 basis points all of a sudden. And we recognize that the 10 years tenor brings a good risk and reward in one's portfolio. So that's what we are saying, a barbell up to 3 years and the 10 years tenor.